Hello everyone, welcome to part three of my video series on Secure Trust Bank. In this episode, we're going to go through the business finance segments, starting with commercial finance and then having a look at the real estate finance business and possibly seeing how the time's going, get on to maybe have a look at the savings segment as well. So the deposit side of things. But before I do so, I think I just wanted to mention I've just put out an update on the company. Um, it's been a very eventful week. It's currently the 3rd of November. I put out this update yesterday on the 2nd, and basically over the last week, the Friday before, so it'd be the 25th, there was a shock ruling from the Court of Appeal that sort of threw um, the whole vehicle finance and wider uh, auto industry into a sort of state of panic, and lots of companies seeing their very big drops in their share prices with STB not being spared. So even though this series I've been calling it, the valuations in this series are now um, a little too high on the video description. It's actually now trading at 0.26 times tangible book value and 3.7 times last year's profit, or 3 times the 5-year average net profit. So anyway, if you're interested to have a look at this, it's under the company updates tab on my website. You can go find it there. And again, subscribe for free. You get these company updates come in to your inbox as and when I send them out. Usually around earnings and events. I also covered briefly the Q3 trading update in the same update there. But anyway, yeah, let's get back to. I'll probably do a full episode on that in the future once I finish this series going through the main report. But yeah, let's start off with the main topic today, which is going through the commercial bit and real estate finance segments of the business. So, STB's commercial finance division was formed in 2014 and provides asset-based lending under the Secure Trust Bank brand. The assets used as collateral vary, but predominantly fall into the following categories: receivables, inventory/stock, and property, plant, and equipment. Historically, loans backed by receivables have made up the majority of the loan book. The credit facilities provided are generally revolving in nature, which allows customer relationships to be perpetuated over long periods of time. To illustrate this, in 2021, client retention exceeded 90% of the average, exceeded 90%, and the average customer relationship had a duration of 6 years. So 6 years, and the this segment was started in 2014, so that was 7 years before. So pretty much, a lot of their initial customers have stayed on with them and grown their balances, growing the facilities over that time. The size of the facilities offered varies between 5 million and 50 million pounds, and these can be drawn down or repaid as required, resulting at times in quite substantial undrawn credit commitments. Many of STB's commercial finance customers have come via referrals from private equity and accounting firms, with which it has built relationships over the years. The partnership with private equity is particularly strong, visible in the fact that more than half of the client book had some level of private equity sponsorship in 2024. There are several factors that make asset-based lending an attractive financing option for businesses. The revolving nature of the credit facilities provided removes the burden of strict and often unavoidable repayment schedules. The underlying asset security typically results in a lower interest rate than regular unsecured loans, and the loan size is linked to the asset base rather than a profit multiple, making it suitable for things like turnarounds where the profits are currently depressed. It also reduces the possibility of the borrower failing to meet a loan covenant due to short-term profit volatility. Also, it would be a good fit for early stage businesses that haven't quite turned profitable yet. The following are some examples of commercial finance customers. As Weldfast UK Limited. So Weldfast is a leading independent wholesaler of welding, cutting, and safety equipment based in Staffordshire. STB has provided the company with a £10 million facility alongside funding from Renewable Capital intended for investment in growth. Next, we've got Light. Light is a manufacturer of access equipment based in Swansea, to which STB has provided a £6.5 million facility to help finance a merger with its competitor, LFI. STB had previously provided Light with a £5 million facility in 2019 to support an investment by Real Capital. So this merger has further expanded Real Capital's portfolio. And lastly, we've got Keystone Brewing Group. So STB has provided Keystone Brewing Group with a £10.75 million facility to support the growth of its portfolio of established regional breweries that currently includes Black Sheep Brewery, Purity Brewing Company, Brick Brewery, and Brew by Numbers. This is another deal involving Real Capital, which is the ultimate owner of Keystone Brewing Group. As it happens, Black Sheep Brewery is actually pretty near to me. There used to be quite a few Black Sheep pubs around, but I think most of them have closed when it was bought out by Real Capital, and they formed this Keystone Brewing Group. So let's have a look now at the loan book growth. So first up, we've got a graph here of the closing loan book and new business volumes. So STB's commercial finance net loan book has grown from £126.5 million in 2017 to £381.1 million in 2023, equating to a CAGR of 20.18%. You can see the impact of the pandemic in the 2020 dip, followed by a pretty substantial bounce in 2021. Something that helped to offset the fall in asset-based lending during the pandemic was the company's provision of circa £58 million to existing customers through the government-guaranteed Coronavirus Business Interruption Loan Scheme, or STB.L, Coronavirus Large Business Interruption Loan Scheme, or CLBIL, and the Recovery Loan Scheme, RLS. By the end of 2023, all but £15.5 million of these lending balances had been repaid. You notice that there isn't much correlation between the net loan book and new business volumes. I believe this is due to the relatively large undrawn component of the credit facilities, which when drawn increases the net loan book without counting as new business. The reverse also applies when balances are repaid and the undrawn component grows. The net loan book falls without impacting new business volumes. Additionally, there's the fact that the facilities are generally revolving, meaning a good proportion of the loan book can be maintained without new business being written. So have a look now at the operating income and risk-adjusted income with the corresponding margins. With commercial finance, a significant proportion of the income generated comes from fees and commissions. So it makes more sense to present operating income which combines both net interest income and net fee and commission income. Operating income grew from £5.8 million in 2017 to £24 £1.5 million in 2023, equating to a CAGR of 27.25%. The variable nature of the loan agreements has meant STB has been able to pass interest rates on to its customers immediately and therefore not suffered the squeeze in margins seen with other segments. Loan impairments have historically been very low, visible in the narrow gap between operating income and risk-adjusted income, but you can see that a significant impairment was recognized in 2023 that widened the gap considerably. This was due to a £7.2 million charge relating to a single long-running problem debt case, described by management as a unique case with characteristics not shared by the rest of the portfolio. They have maintained their impairment provisions at the same level accordingly. If you include this one-off impairment charge, the risk-adjusted income CAGR has been 19.48%, and if you exclude it, the CAGR rises to 26.92%, very close to the rate achieved for operating income. Next, we'll have a look at competition. So the high street banks are the largest lenders in the asset-based lending sector, but there are also a number of more specialist lenders that have operated in the space for more than 15 years. What's quite promising is that STB is gaining on these specialist lenders with a loan book that puts it close to, if not in, the top 5. To give you an idea of the opportunity available, I thought I'd walk through the asset-based lending arm of one of the major high street banks. That being RBS Invoice Finance Limited. RBS Invoice Finance Limited is a subsidiary of the FTSE 100 bank NatWest Group plc. It provides invoice discounting/factoring services alongside broader asset-based lending with assets such as inventory and property, plant and equipment used as collateral. At 31st of December 2022, the company had net loans and receivables of £3,393,884,000 after subtracting an impairment provision of £8,203,000. This represents the drawn component of the facilities. If you include the undrawn component, the total value of the facilities provided was £7,936,170,000. In the same year, the company generated £145,386,000 in revenue, which can be broken down into £103,191,000 of interest income, £36,630,000 of service charges, £4,932,000 of arrangement and termination fees, and £633,000 of other client charges. The net interest expense paid to the group companies was £40,493,000, while operating expenses were £50,147,000, and the impairment charge for the year was £256,000. Subtracting these expenses from the revenue figure gives a profit before tax of £55,142,000 and net profit of £42,892,000 after subtracting £12,250,000 in tax. The net revenue margin can be calculated as 3.08%, with a very similar risk-adjusted margin of 3.07%. These margins are quite low, even excluding the interest expense set at the discretion of the parent company. The revenue yield on the loan book only comes to 4.28%, well below the 6.38% net revenue margin achieved by STB in the same year. This perhaps indicates a lower risk tolerance, which leaves a gap for other lenders like STB to fill. All right, so I didn't realize I've done them in a slightly wrong order, but I'm going to go up now and have a look at the real estate finance segment, which is the other of the two business finance segments. So STB's real estate finance division was formed in 2013 and operates under the Secure Trust Bank brand. Today, it offers a variety of different investment and development loans, primarily for projects involving residential property, which is used as collateral. At 31st of December 2023, residential investment loans comprised 83.8% of the loan book, with the rest being attributable to development and commercial investment lending. So we can see here a graph of the net loan book divided between the different classes. So you can see how it's sort of changed over time. Early on, there was a lot of residential development made up a good portion, and that amount seems to have stayed fairly the same, but they've grown the residential investment a lot, and so that's now become the most dominant component of the loan book. The split between investment and development loans is also weighted heavily towards the former, since the increased collateral provides better protection in case of default. It should be noted, however, that the development loans provide a higher yield as a result of the associated higher risk. The company's focus is on serving SME property developers and investors unable to secure funding from the major high street lenders, a niche that has historically been underserved, allowing STB to grow its loan book rapidly, as you'll see later on. For the residential real estate sector in general, there are significant structural tailwinds due to multiple decades of supply growth lagging demand. This has drawn in a good amount of interest from investors, both domestic and international, from which STB stands to benefit. In the following sections, I'll outline the different loan types offered and then discuss some examples. So we'll start with residential investment. These investment loans are intended to support the refinance or purchase of houses of multiple occupation, aka HMOs, and apartments operated as residential accommodation. The finance terms are as follows. Loan sizes are offered between £2 and £45 million. Maximum terms of 5 years. Maximum loan to value of 70%, though limited appetite above 60%. Drawdown, single or multiple tranches considered, and repayment, interest only, and repayment/amortization offered. So in the case of interest only, it's quite similar with these real estate finance loans that they're quite similar to the I guess the commercial finance, the commercial finance that operates as a revolving credit facility, really, so they don't have to keep refinancing. But in the case of these residential investment ones, even though they have a maximum term of 5 years, in a lot of cases, once they get to the end of that term, they'll just they'll refinance it with STB again, and keep operating it like that. So at the Capital Markets Day on November 2021, residential investment loans were said to make up 60% of the real estate finance loan book, making them the largest segment by a wide margin. I think it must be might be more than that now. In 2023, judging by the graph, but could be wrong. So next we have residential development. So these development loans are intended to support the development or heavy refurbishment of proposed or existing sites with suitable planning permission, to be retained or sold as residential accommodation. The finance terms are as follows. Loan sizes between £1 and £45 million. So smaller starting loan size, but the same upper maximum as residential investment. Maximum term of 3 years, so a couple of years shorter, and a maximum loan to cost of 80%, and a maximum loan to gross development value of 65%, though again, limited appetite above 60%. The drawdown, the funds are released against monitoring survey reports. So as the development of the property proceeds, they hit certain milestones. So if they're not going to keep releasing funds if there's not been any progress with the actual development. And repayment is usually rolled interest with repayment on maturity. As of November 2021, residential development loans made up 17% of the real estate finance loan book, making them the second largest segment. Student housing investment. These investment loans are intended to support the refinance or purchase of HMOs, studios, and shared apartments operated as student accommodation. This includes purpose-built student accommodation, aka PBSA. The finance terms are as follows. Loan size between £2 million and £45 million, subject to a £25 million cap per location. Maximum term 5 years. Maximum loan to value 70%, though limited appetite above 60%. Drawdown is a single and multiple tranches. And repayment is interest only and repayment/amortization. So both options there available. As of November 2021, purpose-built student accommodation made up 11% of the real estate finance loan book, making it the third largest segment. However, I believe this figure also encapsulates PBSA development loans considered in the next section. So I think the student housing investment, probably of that graph we had to look up above, gets included in residential investment, I believe, which is why perhaps this is larger than the 60% it was said to the pure residential investment was said to make up in 2021. So next we have build to rent combined development/investment. These loans are a hybrid of residential development and investment intended to support the development or heavy refurbishment of proposed or existing sites with suitable planning permission to be retained and operated as a build to rent asset. They started out initially with terms resembling a standard development loan, but upon project completion, mature into an investment loan. The finance terms are as follows. The loan sizes, again, between £2 million and £45 million. Maximum term 5 years combined across the development and investment periods of the loan. Maximum loan to cost of 75%. Maximum loan to gross development value 60%. And drawdown, the funds released against monitoring surveyor reports. And then repayment. You've got rolled interest during the development stage, followed by amortization of capital and interest over the remaining loan term. I don't have a specific figure for the proportion of the loan book made up of these development/investment hybrids, but I expect them to sit within the aforementioned residential development segment, which in aggregate represented 17%. I think I asked a question around this with that during this presentation, which was the 2024 capital markets event. And I think they basically said that the loans were categorized in the different buckets depending on what stage they're at. So it starts off in residential development and then it'll progress to being recognized as residential investment as it gets to the second stage of the loan in that graph. So again, right. Next, we have land investment. These investment loans are intended to support the refinance or purchase of land with suitable planning permission to be retained for future development. The finance terms are as follows. Loan sizes of £2 million to £45 million again. Maximum loan term of 5 years. Maximum loan to value of 50%. Drawdown, single tranche, and repayment, both interest only and repayment options offered. As of November 2021, land loans made up 4% of the real estate finance loan book. Commercial development. This is now the final category. These development loans are intended to support the development or heavy refurbishment of proposed or existing commercial sites with suitable planning permission that have been pre-let to a reputable occupier. The finance terms are as follows. Loan size, again, between 2 and 45 million pounds. Maximum loan term of 3 years. So the same as the residential development. Maximum loan to cost of 85% and maximum loan to gross development value of 65%. Drawdown, funds released against monitoring surveyor reports, and repayment, it's the rolled interest with repayment on maturity. As of November 2021, commercial development loans made up 5% of the real estate finance loan book. There was also additional 3% attributable to commercial investment loans, but it appears they no longer offer this as a product. So go through a few examples of loans provided by STB in the real estate finance segment. So first up, we've got Station House in Milton Keynes. STB provided a £35 million residential investment loan with a 3-year term and 59% loan to value to Goldwyn Group to refinance a 200-unit property following its conversion from disused offices. Next, we've got Bridge Street Studios in Birmingham. STB provided a £6 million PBSA investment loan, so that's purpose-built student accommodation investment loan, with a 3-year term and 62% loan to value to Volume.Property to refinance a 70-unit property following its construction. And we've got Scots Way in Cockfield, Suffolk. STB provided a £2 million residential development loan with a 2-year term, 73% loan to cost and 60% loan to gross development value to Larkvale Homes to finance development of 9 luxury homes from a brownfield site. And we've got Chadwell Heath in London. STB provided a £15 million hybrid development to investment loan with a combined 5-year term to finance the construction and subsequent operation of a new 55-unit residential property expected to be completed in January 2025. Then we've got Port One Logistics Park, Great Blakenham, Ipswich. STB provided a £20 million commercial development loan with a 15-month term to Curzon de Vere Limited, to finance the construction of 4 new pre-let warehousing units. This follows an earlier deal in which STB financed the construction of 3 other units. And finally, we've got Interland Residential Portfolio, London. STB provided a £66.4 million residential investment loan with a 5-year term and 52% loan to value to Interland Group to refinance a portfolio of residential properties across Greater London. This agreement served to refinance an existing £42.2 million loan with STB and provide an additional £24.2 million to refinance several other loans with different lenders. The deal was the largest ever done with a single counterparty and in excess of the usual £45 million limit. But obviously over a portfolio of properties, so spreading the risk a bit there. So now we'll move on to have a look at the loan book growth. So we've got the usual graph of loan book and new business volumes. So STB's real estate finance net loan book has grown from £580.8 million in 2017 to £1,243.8 million in 2023, equating to a CAGR of 13.53%. As you can see, growth prior to the pandemic was significantly faster than that seen from 2020 to 2022, though it does now seem to have inflected higher again in 2023. The pandemic impact can also clearly be seen in new business volumes, which fell 40% in 2020 before making a rapid recovery the following year. You'll notice that new business volumes are significantly smaller than the net loan book, illustrating the relatively long average loan term. Consequently, this means there is a lag in new business volume fluctuations being reflected in the size of the net loan book. Now have a look at net interest income and risk-adjusted income with their associated margins. So net interest income grew from £19.6 million in 2017 to peak at £31.5 million in 2021 before falling to £29.7 million in both 2022 and 2023. All of the growth came from the loan book, as the net interest margin can be seen to decrease in every year except 2021. You'll notice that the net interest margin was significantly lower than the retail and vehicle finance segments, which is to be expected given the very substantial security held against the loans that reduces the risk of impairment. So, yeah, just to give you an idea here, the net interest margin has gone from just below 4% in 2017 down to just over 2% in 2023 as they've made that shift from development, which has the higher interest rate, to investment loans. And yeah, pretty tight pairing with the risk-adjusted margin as well. It's just above 2.5% actually. Sorry, for net interest margin. Risk-adjusted margin, it's a bit lower in 2023. But anyway, you can see, however, that there were a couple of years with significant impairments recognized. The impairment charges are a combination of provisions against expected credit losses and actual impairments over and above the level previously provided for. In 2020 and 2023, the impairment charges were due almost entirely to higher provisions against loss, though in the latter year there was a particular development loan to which the provisions were attributable. So this is why they were making the shift away from development to investment, because you have these opportunities for larger impairments with the development loans, because you don't have the asset really such a substantial asset backing them. And if there's some delay in the project, well, so that you could have and it's 85% of the land value, then there's quite a good chance of that land decreasing below that and you recognize some kind of loss. But I mean, they do actually have, I think they also mention, they have, in the last couple of years with interest rates going higher, they have had quite a few defaults on their real estate finance portfolio. But in almost all cases, they've been able to effectively reclaim it from the assets, the underlying assets. They get all their money back, so they've not actually recognized any losses at all. So it just shows you the benefits of being conservative with your asset backing on the lending, and the loan to values and so on that you permit. So yeah, lastly, we'll have a look at competition. So there are obviously a lot of players in the real estate finance market, but within the short-term development and investment finance niche, the field narrows considerably to largely consist of specialist lenders and private credit. Private credit is reliant on funding from institutions like pension funds and insurers, which will expect returns in excess of those available from government debt. This makes them less competitive than banks that are able to raise funds from retail depositors. Since the larger banks tend to prefer long-term mortgage lending, it's predominantly the smaller banks that lend in this niche. To find an example of such a bank, we have to look no further than the previously mentioned Close Brothers. As discussed in relation to vehicle finance, Close Brothers Group plc is a merchant bank and FTSE 250 constituent, around 6 times larger than STB on the basis of shareholder equity. Not sure how true that is now after they were particularly badly hit by the drawdowns in the last week. Vehicle finance, it might be closer than that now. Well, I suppose shareholder equity at present will still say the same, even if the share prices aren't have narrowed, or the market caps have narrowed. Within real estate finance, it offers 4 main products: residential development, commercial investment, and bridging loans. The development loans are broadly comparable to those offered by STB, with 2 notable differences being shorter terms of 12 to 18 months and a lower minimum loan value of £750,000. The commercial investment loans are offered on a pre-let or pre-sold properties in amounts ranging from 1 million to 20 million pounds, with a max loan to value of 70% and max loan term of 5 years. The bridging loans are offered on residential properties in amounts ranging from 100,000 to 4 million pounds. Loan terms of 3 to 12 months. At 31st of July 2023, Close Brothers Property Finance net loan book was £1,703.1 million after subtracting impairment provisions of £41.7 million. The operating income for the same year was £117.9 million, from which we can subtract operating expenses of £30.9 million and an impairment charge of £17.5 million to get the operating profit of £69.5 million. Coincidentally, this was the largest contributor to the group's overall operating profit of £112 million, despite making up a much smaller proportion of the overall loan book. The net interest margin for the segment was 7.4%, while its cost of risk was 1.1%, giving a risk-adjusted margin of 6.3%. It's notable that Close Brothers appears to have a higher appetite for risk than STB, as evidenced by its weighting towards development rather than investment loans. While this has resulted in higher levels of impairment, the company has still been able to achieve significantly larger risk-adjusted margins. I raised this point at the Capital Markets Day on the 3rd of July 2023 and was told that the shift to residential investment was largely a defensive move during the pandemic and subsequent period of interest rate volatility. This is the STB Capital Markets Day, by the way. Was that 2023? Maybe not. I thought that would have been 2024. I've misstated the year there. Anyway, they also said they are considering a shift back into residential development over the coming years as the outlook for the sector is looking more positive. Commercial finance. Oh, we've already had a look at commercial finance. So that sums up that ends the real estate finance and commercial finance segment. So we'll just have a quick look now, maybe at savings. So I don't think this will take too long, and then we can move on in the next episode, having a look at the wider group financials as a whole. So all of STB's deposits are held in savings accounts as it does not at this time offer any form of current account. Within the category of savings accounts, there are four distinct types: access, notice, ISA, and fixed rate, aka term deposits. The key features of each are as follows. Access. As the name suggests, the money can be withdrawn at any time. The interest rate is variable and the deposits range in size between £1, £1 and £250,000. Notice. Not currently offered to new customers due to customer preference for other account types, but historically they were similar to access accounts, with the difference that withdrawals required a given notice period that in turn impacted the interest rate paid, i.e., a longer notice period paid a higher interest rate. ISA, or individual savings account. These are fixed rate accounts with durations ranging from 6 months to 7 years. As well as the rates being fixed for this period, the deposits also cannot be withdrawn without it paying a penalty. The interest rates paid follow the yield curve, so at the time of writing, the shorter duration bonds carry a higher interest rate due to the expectation that base rates will soon be falling. The interest rates are lower than those offered on the standard fixed rate accounts, owing to the fact the interest rate is tax-free. Sorry. Minimum deposits. The minimum deposit is £1,000, while the maximum is £1 million. Also, the aggregate limit for a single customer across all their accounts. And then finally, we have fixed rate, which carry the same features and restrictions as the fixed rate ISAs, with the exception of the tax shielding on interest payments. So, yeah, as I mentioned, fixed rate ones are typically going to have a slightly higher interest rate than ISAs because you don't pay, well, you do pay tax on it. So it works out about the same what you keep after tax. The accounts offered at any one time vary in line with the funding requirements of the company. For example, at the time of writing, fixed rate cash ISA accounts are only offered in 1, 2, and 3 year durations. In the UK, individual deposits of up to £85,000 are covered by the Financial Services Compensation Scheme, FSCS. At 31st of December 2023, 95.6% of STB's deposits fell below this level and were thus covered by the scheme. So, not exposed to any of the Silicon Valley bank issues of having lots of large depositors all withdrawing at once. Now have a look at the deposit growth and split. Total deposits grew from 2 billion and 20, so yeah, 2 billion, 20 million and £300,000 in 2019 to 2,871.8 million pounds in 2023, equating to a CAGR of 9.19%. Over this period, the composition of these deposits has changed considerably. Notice deposits range between 32.9% and 36.7% in 2019 to 2021, but have fallen to just 6.1% in 2023. Meanwhile, ISA deposits grew from 1.9% to 21.9%, access deposits grew from 1.1% to 18.2%, and fixed-term deposits dropped from 64.1% to 53.9%. Though if you include the ISAs, fixed-term deposits made up over 75% of the deposit base in 2023. These shifts can mostly be attributed to changes in demand. With interest rates rising, the ISAs become more attractive due to its tax shielding properties. Similarly, why would people be inclined to use a notice account when they can get interest rates around 5% with instant access? total funds raised. So the funds raised annually have gone from 560.2 million pounds in 2019 to 1,719.1 million pounds in 2023, equating to a 32.35% CAGR. This is far in excess of the overall growth in deposits, so implies a shift to shorter duration deposits. There is likely to be a further large rise in funds raised during 2024, that's 2025, as the company intends to use customer deposits to replace 390 million pounds of funding from the Bank of England's TF SME scheme when it matures. STB has had very little trouble raising deposits due to the competitive rates it offers, so it's unlikely an inability to raise deposits will limit the company's growth anytime soon. In 2023, STB launched a mobile banking app for iOS and Android that allows savings customers to manage their accounts with actions including the following: checking balances and current interest rates, viewing recent transactions, transferring funds, viewing statements, and sending secure messages to customer support. The functionality required is pretty minimal since only savings accounts are offered, but the app does a good job of delivering the features it has, as evidenced by a 4.8 out of 5-star rating from 331 reviews on the Apple App Store and 4.4 out of 5-star rating from 56 reviews on the Google Play Store. I've personally tested the Android app, found it to be simple to both set up and use. Yeah, very happy with the app myself. And it's particularly good to be able to see the interest rate change and so on, because I've got an Access account open with them. So I can see that move around with the broad interest rates. I think it's currently 4.55%, the Access account I've got at the moment. Yeah, I think that finishes. We've gone through all the segments now. So what I'll do next is we'll have a good breakdown of the financials more broadly, looking through the income statement, financial position. Obviously, a lot to break down in there with all manner of funding ratios, etc., and liquidity, breaking down the credit risk in detail, impairment allowances, etc. Then we have a look at the cash flow statement, looking at how that's changed over time. Dividends. And then, yeah, I think I'll probably try and put it all together into one thing, because then we have the look through the management, executive compensation, etc., ownership. And then finally valuation, etc. So yeah, if you want to, as a reminder, if you want to read this your full report, you can find it over on firmreturns.com if you want to read all of this detailed stuff, which looking at the segments, etc., and all this, everything below the initial executive summary and the retail finance segment covered in the first video. Any of this other stuff, it would have to be a paid subscription, but I think it's very reasonably priced. You can pay £30 for an entire year's subscription, 12-month subscription, which works out to be £2.50 a month equivalent. And that will get you this, and it will also get you portfolio updates. So when I also sent out the last week, I made a couple of I added to my STB position. So when I did, on the days I do that, you'll get an email in your inbox telling you that I've added to it, or if ever I sell companies and stuff like that as well, you get notifications about that. That might be of interest to you. And but yeah, if you just go over to the website, you'll at least be able to have a look at the executive summary and the initial sections. And then, as I said, you can get all of these company updates. So all of these company updates I put out, which normally after I've done the initial report, then as I cover the sort of half year or full year results or just key events, like if there's some important event happening, as there was here with STB, I'll put something out. I probably wouldn't have put something out otherwise. If it just been the Q3 trading update, I probably would have waited for a more, the full year results to be the next one. So, similar things with have been similar things with Tiny Build and so on, which is another company I own and cover a fair bit. Key events at the beginning of the year, they did a capital raise and so on. There was a bit of a whole flurry of of reports coming out over those kind of months. But yeah, I would say on average, you just with the free subscription, you probably end up getting around about one a month. So let's have a look. So just have a look through. So these a couple in September, one in October, one so far in November. So yeah, they're not like on a, but then it was a pretty big gap back to 30th of April was the prior one before that. But obviously I put out the STB report in between. So in July, yeah. So yeah, you'll get the, and I mean even when I put out a new report on a new research report as well, you'll get that in your inbox. You'll just have a reduced version, as you'll see, just probably an executive summary in future for those. But that still gives you a pitch and so on if you're interested. But yeah, it'd be nice to get a few more people doing the sign up to the paid subscription to support the newsletter. But anyway, yeah, that doesn't matter either way. You're very welcome to just remain a free subscriber. Right, okay. So I think that's going to wrap up this video. Please give it a like, comment if you've got any questions or anything on that. And I'll see you in the next one, as we probably going to be the final episode, part 4, covering the main body, the financials, and all the rest of the report. Expect it'll be quite a long one. But yeah, I'll try and wrap up the final details of that report. And then there's a couple of subsequent company updates on STB to do as well. So I'll put those out probably in the weeks after. It's all right. Anyway, I'll see you then.